I think it's pretty significant to say that we haven't seen that often four straight down weeks like this. We haven't touched the 50-week moving average since last year. So we're seeing a change in character.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Today, we are resuming our monthly discussions with the team at New Harbor Financial, one of the endorsed financial advisory firms here by Thoughtful Money. And gentlemen, it could not be more timely. So folks, as usual, I'm joined by lead partners Michael Preston and John Lodra. I think today the S&P has officially entered a correction phase in terms of having dropped by over 10%. Gold has hit an all-time high. So there's lots going on. A lot of things that you guys have been basically over the past months telling us to watch out for seem to be underway in real time. So let's just dive right in. Let's actually talk about the downwards action in the markets. John or Mike, which one of you guys wants to go first?
No, really, either one of us. Why don't I just kick it off here, Adam? You're right. The S&P is now in correction territory. It's down, looks like, 10.3% from the high. I will bring up a chart so I can share and we can talk about a few things on the chart and give you our quick feedback and
Okay.
perspective.
And as you're pulling it up, Mike, let me just let folks know. So we're recording this at the end of the day on Thursday. So there's one more day left in the market action before this video is going to go live. Also, the day that we're recording this is 2 days before Thoughtful Money's spring conference. So when this video launches, it'll be Sunday, the day after the conference. If you missed the conference, folks, it's going to be such a great event. But if you missed it and are regretting that, given all that's going on in the markets, you can still buy a replay of the entire event. It's already available for purchase, all the presentations, all the Q&As. To do that, just go to thoughtfulmoney.com/conference. All right, Mike, you got the baton again.
All right, so back to the chart. Here's the S&P 500 on a daily chart, down around 10.3%. One thing to note here is this has been a pretty relentless decline. We went right from all-time highs, which is right up here, 6147.43. And that high was just higher than a recent top edge of a triangle here. So it's a pretty classic textbook bullish triangle breakout to new highs. Well, we went straight from that straight down. There's been almost no reprieve here. This light green line is the 21-day moving average. We haven't touched the 21-day moving average in 10 or 11 days. And, it seems to have been actually increasing in slope. So it's been a pretty steep decline. Now, overall, it hasn't been that big of a deal yet, other than it's now brought us negative on the year. Right at this back here where my arrow is the beginning of the year. It looks like we're down around 5, 6, 7% on the year on the S&P. If we were to take a look at the NASDAQ 100, it's even a little bit more severe. That's down 12 to 14%, the same straight line. On the NASDAQ, right through the 50-day moving average, which is the red line, right through the 200-day moving average, which is the green line, and really hasn't even bounced, just hasn't even noticed these things and hasn't touched the 21-day moving average. So it has been a pretty swift decline. It's been even more concentrated in the momentum names. Take a look at this ETF. This is the IBD 50, the Investors Business Day Top 50. It dropped close to 30% in a straight line. So it hasn't happened that often. If I go back to the S&P and I change to a weekly chart, you'll see that as of right now, it's Thursday, we're working on 4 straight weeks down. 1, 2, 3, 4. Look back over the last couple of years, it hasn't happened much, hasn't happened often. It happened during the Japan swoon last summer. The fourth week ended in an up bar, key reversal, and who knows? It's possible that we have a key reversal coming up, maybe even as soon as tomorrow, to change the shape of this bar. But I think it's pretty significant to say that we haven't seen that often 4 straight down weeks like this. We haven't touched the 50-week moving average since last year. So we're seeing a change in character. Our short-term indicators have reversed into defense. They're getting a little bit stretched, but they're not extreme yet, which says that we could have further downside. I think the key point here, Adam, is we're not guessing. We're not trying to predict. We have a system in place that hedges our risk. The chart that I just had up I know that I stopped sharing it, showed a line, and maybe I'll reshare it again just for the sake of clarity. There's a line where we have our hedges. We just adjusted our hedges. They were up at 5,700 right up here for March, and we just rolled those out the other day down to 5,400 and rolled them out to April. This is on 15% of our portfolio. We have 40% stock right now. So as we go down near these hedge lines, we're automatically reduced to 25% stock and we take some profits on those hedges. Now, it's not perfect. There's costs to hedges and there's a deductible where you see the space between the price and then and that hedge line. But still, even with all of that, we're still, slightly up on the year in positive territory in our main model for most accounts, and the market's down, 6 to 12%, depending upon which index you look at. Now, it should be stated, to be fair, that this is a short period of time. Other periods of time might be different, but as of right now, this is how we see things and what our experience is. We're looking to get good, consistent, fair returns. We don't need big returns. I mean, being only 40% in stocks is not going to give you big returns no matter what happens, but we're trying also not to lose on the turn. We don't know if this is it. Is this the one? Is this the top in the market and now we're going to crash? Or is this a pause that refreshes? Well, maybe John will talk a little bit more about that. We'll make some guesses later on. But so far, we just don't know. We don't know. And so therefore, this is how we're managing it and trying to have it have decent results no matter what happens.
All right. So, I'm sure you guys are hearing from people who are, beginning to look at their portfolios and starting to get a little bit worried. And we'll talk about that in more depth, hopefully later in this conversation. But I just want to point out, I want to shine a light at you guys. So I have you on this channel every week, so that people can see how by my standards, how a good quality professional financial advisory firm thinks, acts, and operates, right? You guys are updating us on a weekly basis about how you see the world, any potential changes you're making to your portfolios in response. And certainly of late, you guys have been saying, certainly coming into this year, talking about how extreme valuations were to the upside, right? And about saying, hey, look, nobody knows how long this is going to continue. We're not saying a crash is imminent. We're just saying that valuations are stretched to extremes that we've rarely seen, and therefore we're going to be more defensive going forward. And then for every week, month, whatever, that markets kept marching higher, people will throw slings and arrows saying, you guys are too defensive, you're missing, these easy gains. Well, it's because of moments like we're seeing now, which is why you guys have taken the approach that you have, right? Defense isn't sexy, especially when the party is still going on. But once losses start getting incurred, it's what everybody wants. And of course, it's the kind of thing you have to have in place before the correction. So I do just want to give you guys some well-deserved props, because I know it's not easy to be the one who's making the argument for conservatism and prudence and whatnot, especially when the euphoria is crazy. And you may remember a few months ago, I literally put up the euphoria meter that showed that it was at the highest rating it had ever been on the street. So again, kudos to you guys for having the mental fortitude to stick to your guns and go through that. And I'm sure you have a lot of happy clients right now. All right, John, well, let's transition over to you. What else would you add to what Mike said? And maybe also the question that Mike raised. What do you think is more likely? Is this the big one and expect a lot more below, or do you think the markets will at least have a short-term bounce here coming up soon?
Yep. Well, that's Mike referred to our battery of indicators that we look at and help guide us. It basically gives us clues to the momentum and the sentiment and the actual actions of investors en masse. That ultimately is what drives markets. High valuations, like you just already talked about, aren't enough to invite a sudden and significant drop in the stock market. Just like we can categorically say some areas of financial markets are way better valuations, like foreign stocks, yet foreign stocks have been significant laggards to US stocks for the last several years. That seems like it's underway of changing. We've seen some notable relative strength in US non-US stocks so far this year. We'll see if that has a durable trend, but these are the kinds of things that we look for. In terms of the action, yeah, Mike talked about how it's been pretty much unrelenting down. It's a, there's sentiment indicators out there. I know we've talked with you and others on your channel have talked about how bearish people got. Some of the sentiment surveys showed a level of bearishness that has only been observed after major declines, 20% or more, and yet we were seeing those readings just a few percent off the highs. Now, those are anecdotal data that we want to take into account because it does speak to at least one view on mood. But if you look at other things, like one of the things that's been somewhat baffling to us, and I think we haven't seen a really capitulatory move in these markets. So I'm going to share some charts here and just kind of show you some of the things we look at. So this is a chart of the S&P 500. Mike already shared that. I think Mike mentioned we had hedges at 5,700. We just recently booked profits in those, so that offset some of the downside that otherwise would have been in client accounts. We've reset that. So we still have very good tight protection here if we do see a further decline in these markets. But we also book some profits. So if we do get a short-term bounce, which is increasingly likely when you think about probabilities, we would characterize this market as exhibiting the kinds of internals that are associated typically with a sell the rips kind of market. If we get these short and fast rallies, it typically, when these kinds of indicators are flashing as they are now, suggests, hey, this is a great rally to sell into, rather than assume we're going to take out new all-time highs. We'll change our tune as the data does, but if you look at a shorter term chart of the S&P, let's look at an hourly chart. Each one of these bars is an hour. So here's today's action. There's very little in the way of very sharp drops or spikes. There hasn't been a complete capitulatory event. If we look at things like the VIX, let's take a look at the VIX. And I'm going to zoom out on this one here to a longer term chart. This is a daily chart of the VIX going back, I guess, a year. And we've had this rather calm ascension of the VIX here. Whereas you look at, for example, last August, we had a spike that went to stratospheric levels in the matter of a few days. Even back here in December, pretty short but spiky kind of capitulatory move. We haven't seen that at all in the VIX right yet. So that's a thing that we're looking at. I want to kind of just speak to the sequence of number of down weeks. The folks at Nasdaq Dorsey Wright did a study, and I'll just share some summary that they have on that. This is a study looking at the number of negative weeks, consecutive negative weeks. So, for example, since 1957, there have been 209 instances of 2 weeks negative in a row, and average of three times a year. Here we are in week 4, I think, if I'm not mistaken. It's obviously much fewer incidences, but there still have been 50 instances since 1957. And there have been times where we've gone out 6, 7, 8 weeks consecutive negative returns, weekly negative returns in the S&P. So it's not unheard of. Who knows? We'll see whether we continue. But the takeaway of the further study they did is the longer that the consecutive weeks happen, typically the worse follow through results. So this is a busy chart, but let me see if I can distill it to the essence. So when you have 3 weeks of negative returns, usually the percent positive in returns in the week that follow are this. But the further you get out, so 5 weeks, 3 months later or 6 months later, you only have 63 and 41% positive versus highs, mid 70s. So the takeaway from this is the longer we have a consecutive negative week, it speaks to likely something bigger in terms of a more systemic sell-off that has greater consequences of, hey, these markets just don't bounce right back. They could be down for several months, if not a year or longer. Remains to be seen if that's what happens. We think actually we're primed for a very short-term bounce here at some point, but we still would like to see that capitulatory sell-off before we have greater confidence in that.
Got it. Yeah, maybe a bad analogy, but it's maybe not unlike a search and rescue situation, which is the early hours are super important, and the longer you go before you find the person you're looking for, the higher the odds are is that this is going to switch at some point in time from being a rescue operation to a recovery operation, right?
Yeah, I think so. And the less capitulatory this is, it still builds hope that, hey, it's, we're going to rise. So you kind of need that capitulatory thing to really, dash some hopes, I suppose.
All right, and let me just share a screen on that on this. So this was something that Lance Roberts had shared on his Twitter. It's a chart from the Daily Shot, but it's basically showing that as the S&P has really started to ride to the downside here, it hasn't impacted retail buying. In fact, retail buying has risen more or less into that. And so the point here was this isn't capitulatory behavior yet, right? Normally, when investors, so in other words, investors are still trying to find the bottom right now. And this is probably a sign that things are going to bounce at some point because people are bottom hunting. When we get to the point where the bottom doesn't show up and then retail people start giving up and just not trading, that may be a sign again that it might be something more longer and more prolonged. So we'll want to keep an eye on this data.
Yeah, I want to add one thing. Obviously, we're in the business of managing money for real people that have real lives, that money is about their financial security, typically in retirement. It's not about posting your results and, compared to your neighbors on the neighborhood bulletin board. It shouldn't be about that. Sometimes it is, and that gets into a whole other realm of uh, behavioral finance and the biases and the flaws that we all have humans. I actually just recorded a video that will air on our YouTube video channel later this week on the common biases and some examples from history as to how these can be very damaging. But what I would say, because even though we may see the very likelihood of a short-term bounce here, again, I think the indicators tell us it's likely a market that's a sell the rip kind of market. But please don't take that as a permission to say, if you're overexposed right now, well, we'll wait. No, now's the time to take defensive action, to get more conservative. Doesn't mean you have to, you're going to have some regret either way. You're either going to sell too early and you could have picked a higher high, or you're going to sell too late. It's not too late to sell down if you're way overexposed, because we do think ultimately this market trends lower, if not after some short-term bounces. Don't
Well,
try.
John, and if I can just say that, so first off, a lot of the other money managers that I've been interviewing recently share your mentality there that we probably are in a sell the rip type environment here. But having just done the conference the day before this video airs, I can tell you from all of the presentations at the conference that the vast majority of folks I interviewed do think that the probability of the market direction this year is further to the downside as we go through 2025. So again, nobody has a crystal ball. We don't know if these guys are right, but I can say that the overwhelming consensus of the smart experts at the conference were, hey, this is unlikely to be a year where we have a little bit of volatility at the beginning and then it's off to the races again. There are some both valuation wise, still even at these levels, but also really more structural issues that are exacerbated by policy right now that give the preponderance of the probability to the downside. So to your point, John, if you're feeling overexposed, if you're feeling like you wish you were more defensive, yeah, you might get a rip to sell into from here. But if you're looking at the year at large, better to be safe than sorry and just start taking action sooner rather than later to get defensive.
Yep, that's a great way to put it. Absolutely.
All right. So, Mike, the other thing that's going on this week, and I'm switching topics, so feel free to add to what John said if you want to, but I know that we're all a little short on time today. One of the other real notable things about today, as I said in the intro, is that gold has raced off to a new all-time high. It's been actually flirting, at least in the futures market, with 3,000 an ounce today. Again, love to hear your thoughts on that. But of course, New Harbor has for many years had positions in gold. You guys coming into this year, Mike, all really last year and into this year, you've been telling us that the technicals were setting up for a potential big run in gold. Of course, there's been a lot of things that have been fundamentally supportive of gold that are going on. And so, you've been saying it wouldn't surprise you at all to see gold hit 3,000 an ounce in the first half of this year. looks like that prediction is probably going to come true in a couple of days.
Yeah, gold is at 29.82 right now. I'll show a chart of gold, or at least an ETF that tracks gold here. But there's a nice additional cup and handle breakout in gold. Gold has had just this beautiful chart for a long time. The long-term chart, weekly and monthly, has been consolidating and had a cup and handle breakout. I'll just show you the month. This is basically over 10 years. This cup, long handle, and then this breakout here above 2,000 just hasn't pulled back at all. If we go back to the daily chart, there's been a nearer term consolidation over the last couple of weeks and the last couple of weeks and the last couple of months even. But we just broke out today out of the last couple of weeks consolidation. This is a nice big breakout in gold. And so on the spot market, we're close to touching 3,000. I think the next level will be 3,200 to 3,400 for gold. Silver also is breaking out, hasn't quite made a new recovery high versus its old one here, and certainly hasn't made an all-time high because that all-time high was way back here at around 50 in 2011. So we got a long ways to go for that. But just take a look at the monthly chart of silver while I'm on it. You can see we broke out of this triangle consolidation. And then lastly, over the last 6 to 8 to 10 months, we've been going sideways and we're now threatening to break out on silver. Next levels would be 34-ish on this ETF, which would mean 38-ish or 38 to 40 on silver. So the levels for silver would be 38 to 40 and gold 3,200 to 3,400. And of course, this is helping out the mining shares. Let me go into the nearer term. Let's start with the weekly actually. This is the weekly chart of GDX. It made a recovery high back here in October to 44, and then this was this heartbreaking drop. And now I'm beginning to think that this drop is what had to shake out the last of the weak hands, because from there it's just been a straight up move on the weekly. Now even the last few weeks has been a little bit challenging for people that are in gold stocks because on this pullback it kind of felt like, oh no, here we go again. But that ended up turning into be the handle. So we have yet another cup and handle, and we've broken out to the upside. As we speak, we're challenging that old high of 44. If I go back out to the monthly, to my eyes, if we break out here, we should be going up to 50, 52, low 50s on GDX would be the next stop. So very supportive, gold and silver taking off. And the last thing I'd say is the mining shares on a relative strength basis are starting to outperform gold over the last few weeks, few months. Mining shares right now are up 3.08%. Gold is up 1.76. So today that's the same thing too. I think that we're going to start to see gold stocks. I'll go back to them. I think we're going to start to see some catch up finally with some relative outperformance in gold stocks. So, those are the levels I see. Again, always you should take into effect your own risk tolerance and not overexpose yourself. Have the right allocation. Talk to an advisor. Talk to us if you'd like. We'd be happy to help you.
All right, great. And Mike, how encouraging a sign do you take it that in the past couple of weeks, the mining stocks have basically bucked the market trend, right? Where we've had this pronounced sell-off in the market, and long-suffering mining stockholders sometimes feel like they get the worst of both worlds, right? That gold goes up, but the mining stocks don't, and then the market goes down, and gold goes up, but mining stocks decide they want to act more like a stock than something that's tied to gold. We're actually getting what I think folks were finally hoping, which is, hey, mining stocks start reflecting gold strength and actually start multiplying it. Do you see that as an encouraging sign for the future price action from here?
Well, yeah, that's what we're starting to see. We're starting to see the trend being bucked. I'll show you the chart of the dollar here because I think the dollar has a lot to do with it. There's whether it's because their current administration wants lower dollar prices, which is what they've said, or whether it's just market forces, I don't know. But the dollar's fallen from 110 to 103, this year alone. That's 6% or so. And so that's helped gold and silver go up. Gold and silver have gone up even while the stock market's gone down. So the stock market's gone down, the dollar's gone down, gold and silver's gone up. And finally, lastly, I'd say, finally, we're starting to see the mining shares outperform gold itself. It's been a long, long time where that was not the case. And over the last few weeks, you're seeing that be the case. And if you look at momentum screens and growth stock screens, You'll see a lot of names, like in the Investors Business Daily, the IBD Top 50. If you were to take a look at that, which I think maybe they publish on their website, but it's the growthiest stocks that are outperforming on a technical basis. It's littered now with gold stock names.
Wow,
There's a
and
lot.
we've been talking about this for a long, long time, which is, Wall Street really hasn't cared about the gold story for a long time, but Wall Street loves momentum, and I think they particularly love momentum when the market in general is going down. So, hey, where can I put my money where I, can actually get a good return, and then actually one that looks like it's got some really good momentum behind it. So
Yeah.
this not promising, but this might be the moment, fingers crossed, when Wall Street wakes up to the mining sector. And just a reminder for folks, the size of the mining sector market cap wise is on a relative basis tiny compared to the general market.
Sure is. And there's only one stock in the S&P 500 that's a mining stock, and that's Newmont. And even Newmont, which had some negative reviews to recent earnings reports, is hanging in there and climbing back. And so if money managers want to buy a stock, and it's many times it has to be in a big index for them to consider it, there's only one to pick, you know, and the whole space itself is really small. So that's not an endorsement to say go out and buy Newmont. It's just a point. It's used to illustrate how small this whole sector is.
All right. Well, look, folks, in case you haven't noticed, this week on gold, folks have been asking me forever, and it just took me, given everything else going on, really too long to get to it. But I did finally publish Thoughtful Money's Guide to Buying and Storing Gold and Silver. It's available for free to all readers. So if you're somebody who's thinking about creating a position in precious metals, or maybe you're still new to the space, want to understand the different options out there of what to buy, physical bullion, that you own, stored physical bullion remotely, paper gold through ETFs, mining companies, etc. It's a really good primer for that. So if you want to go read that again for free, just go to thoughtfulmoney.com/gold. And we also announced that Thoughtful Money has entered into a partnership, just as we have financial advisory firms like John and Mike's firm, New Harbor, that Thoughtful Money endorses. We have endorsed a precious metals dealer for people that are looking to get into precious metals, but want to know, want to have the confidence that they're working with a quality provider, and one that will actually talk with them on the phone, answer personalized questions, come up with a personalized recommendation for you. And that is Andy Schechtman's firm, Miles Franklin. And if you want to go talk with them and get specialized treatment, just send an email to info@milesfranklin.com, and Andy or one of his lieutenants will reach out to you personally. Andy has promised me that Thoughtful Money users will get the white glove treatment. So make sure when you reach out to him that you tell him that you're coming from Thoughtful Money. All right, John and Mike, in wrapping up, John, let's go to you. I know that you have been thinking a lot about those behavioral biases that you mentioned earlier. This is a very emotional time right now for investors. So what are some of the emotional or behavioral pitfalls that you would encourage folks to avoid during a time like this?
Absolutely. I want to quickly just tie into gold one last thing, and I'm going to do so by way of the somewhat shocking uh, GDP now numbers that flashed across our screens in the last week. For those that aren't familiar, the Atlanta Fed prepares what's called a nowcast, a GDP nowcast. And unfortunately, many people view this as a forecast rather than what it truly is, a nowcast. And what that means is this gets updated many times prior to the final release of the GDP numbers, and it can cycle rather dramatically. And for example, this is what it looks like as of the last estimate of March 6th. It was negative 2.4% GDP growth, negative growth, right? And look at the cliff that it fell off here. Now, underneath the surface here, there's some explanatory variables here. Most notably, there was a massive surge in imports, and especially imports of gold into the US. That imports are treated as negative GDP growth in this calculation. So this massive, whether it's front running of tariffs or whatever you want to call it, is in large part to explain this massive drop off. So people were like, "Oh, we've gone into recession and we're imminently going to crash." Hold up a little bit, because there's some really explainable data there, including these massive imports of gold. So I just want to tie that into gold. But yeah, back to the behavioral stuff. Look, there's many biases and behaviors that can trip us up as humans. We might as well talk about the surprising strength in the kind of AI stocks and the Mag 7 and large cap growth stocks, US growth stocks. Those were all the rage last year and frankly the year before. But this year they've been quite the disappointment. And here's where, falling in love with a sector or a thesis or a stock can be very damaging because, it traps people into thinking, oh, geez, it's already down X%. I can't sell now. Or, I think it's going back. This is temporary. And very well might be the case. But a lot of these positions have become oversized positions in folks' portfolios. It's always prudent to think about position size. And it doesn't matter that you have whether you're still up. Many people are still up massively in those kinds of stocks. You shouldn't be thinking about I didn't sell at the top. I can't sell now. You should be taking a step back and saying, you know what? I rode this probably longer than I should have.
Mhm.
The fact that it's off is more testament to my biases and my overconfidence perhaps than that I made a bad decision selling now after it's dropped. So those are just one example of the kinds of things we see, and we work really hard to try to unchain our clients and folks we talk to from these biases that, hey, if we weren't driven by data systems that help us keep our wits, we'd be just as prone. And we're not perfect. We've made every mistake in the book, trust me. But we work really hard to help our clients get control of these biases that can do real harm to them.
Well, thanks, John. And as I said, it's a main reason why I have you guys on this channel and why we refer people to financial advisors like you guys is oftentimes as individual investors, regular, real people investors, it's not the market that's our worst enemy, it's ourselves, right? We tend to let our evolutionary wiring, basically our emotions, drive a lot of our decision makings, and usually emotionally driven decisions they drive you to make the wrong choice at the wrong time. And there's one of the behavioral thing I just want to mention. I've been mentioning it a fair amount recently, but this is a good week to underscore it for folks. One of the great behavioral economists was Daniel Kahneman. Folks may remember seeing his bestseller book, Thinking Fast and Slow. But he won a Nobel Prize in economics for his work on developing prospect theory, which amongst other things says that humans experience the joy of a gain about half as much as they experience the pain of a loss, or said another way, a loss stings twice as much as a gain feels good, right? And when you're driven by greed, meaning, markets generally are in a state of either greed or fear, right? It feels good. And you can feel pretty bulletproof, when the wind's at your back, and especially over the past several years where there's been a lot of liquidity shoved into the system that's pushed everything higher, you can start to feel like a genius. But the reason why, we, and especially guys like you guys at New Harbor, we're waving the flags of like, hey, folks, this is a little too good to be true, and you should plan for this to eventually, not end well. You're doing that not to just be a wet blanket. You're doing it to say, look, we're trying to protect you from losses because we know that losses are going to hurt you much more than these gains are going to help you. Right. And
Yeah.
especially as you like to say a lot, John, your clients, they don't retire for a year or two. They want to retire for the rest of their lives. And so you want to make sure that first and foremost, you're providing good loss prevention, even more so than trying to stretch for that extra gain. And of course, I think a lot of people are getting a crash course right now in how much losses sting, given what's been going on in the markets the past couple of days.
Yeah. Adam, you mentioned Kahneman's work. I haven't read the full body of his work. I'm very familiar with it. But the irony is that aversion to loss can ironically cause the very behavior that invites losses. So, for example, the fear of missing out, the fear of losing opportunity is a fear of loss, a different kind of loss. But what many investors do as a consequence, they herd into things that everybody else is doing because they don't want to be alone. If they're going to lose, it's better to lose.
That's our evolutionary wiring. We were wired
Yeah,
that there's
yeah.
safety in the herd, right? Yeah.
So what does that do? That's what causes bubbles, herding into things that have gone up, and the fear of losing by missing out is every bit as damaging. In fact, can be more so than simply investing in something by yourself and suffering a loss. It's really the phase of markets we're in right now are so intertwined with psychology and really bad psychology. And this is why we can look back at every bubble in history and say, oh, it was obvious. Look at all this crazy stuff, but no one seems to notice it, or very few people seem to want to notice it when it's happening.
Right, right. Yeah, the old John Hussman, bubbles. You gotta make a choice. Feel like a genius now, or feel like a genius later, right? And most people enjoy feeling like a genius now, but when the reckoning comes, it's a whole different story. So, to quote one other investing great as we wrap up here, Warren Buffett famously said, "It's when the tide goes out that you find out who's been swimming naked." I've been talking a lot recently about really being honest with yourself about what kind of investor you are. If you're a DIY investor, if you're managing your own portfolio, are you good at it? Or are you kind of fooling yourself that there's other things that you could be getting a better return on your time for, and you might be better off if you don't have a great track record, farming that out to a professional, right? So this is a good opportunity, right? There's a lot of people that have, well, every investor's just gone through what the past couple of weeks have done. If you're looking at your returns and saying, you know what, I had way too much exposure. I wasn't as smart as I thought I was. I didn't put myself in the position I wanted to be in. Then it's a really good question to ask. Okay, do you want to continue operating like that? Or, maybe do you want to bring in a professional to help you out? If you have a professional advisor, how have they done through this period? Has their strategy had your back here? Or maybe they had too much risk baked into your portfolio. Maybe they're not returning your calls right now, right? So this is a good opportunity just to take a honest, eyes wide open assessment of where you are. And if the behavior that got to where you are right now, you don't feel served your interest very well, you've got the agency to change that behavior, right? So make that honest assessment, and whatever the answer is, as long as it's for your better interest, great, do that. But if you're one of the folks that are thinking, yeah, you know what, I might want to get some help, or at least I might want to talk to somebody who might be able to help me and just hear what they have to say, highly recommend that if you are not already working with a good professional financial advisor who's taking good care of you, that you consider scheduling a free consultation with one of the ones that Thoughtful Money endorses, perhaps even John and Mike and their team there at New Harbor. To do that, just fill out the short form at thoughtfulmoney.com. It only takes you a couple seconds to fill out the form. The firms will be in touch with you right afterwards. Reminder, these consultations are totally free. There's no commitment. There's no expectation to work with them. It's just a free public service they offer to help as many people as possible, position as prudently as possible in advance of what might ever happen. And I've got to tell you, John and Mike, I'm guessing there are a few folks watching this who've heard me say this week in and week out, who are thinking, you know what, I really wish a couple of months ago I had made the call then, because it might have saved me some of the losses I've taken over the past couple of weeks. But anyways, gents, it's been great. Folks, if you've enjoyed these, monthly full dedicated sessions with the team at New Harbor, please let us know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. And if the feedback continues to be very positive, we will keep doing these going forward. Thanks so much, John and Mike. I know we got to cut it a little bit short this week, but a great week. Thanks for keeping everybody updated on what's going on.
And thanks for having us, Adam. We really appreciate it.
Thank you, Adam, and great luck to you in your conference this Saturday. It's always a huge event, chock full of knowledge. We're going to tune in as much as we can to take away, I'm sure, many learnings, as your attendees will as well. So thanks for putting that up.
Thanks, John. And you guys are a big part of it, answering folks' questions throughout the day. So I appreciate that very much. And yeah, we'll, I'm sure, be, toasting each other at the time this video releases that we made it through the whole 10-hour event. And a reminder to folks that if you didn't attend the event, didn't buy your ticket, but would like to see it, just go to thoughtfulmoney.com/conference to buy the replays. All right. Thanks so much, boys. Everybody else, thanks so much for watching.